How do savvy investors use asset allocation to diversify their portfolio? And what exactly is it? Let's take a deep dive. Asset allocation is an investment approach that involves spreading your investments among different assets, like stocks, bonds, or cash. The idea is that each asset class reacts differently to economic shifts. For example, when the economy is booming, stocks might surge while bonds may remain steady. By dividing your investments, you're essentially cushioning your portfolio against potential losses. If one asset class underperforms, others might compensate, helping to reduce your overall risk. Of course, you may still experience losses, but the losses may not be as severe. Let's start with some of the more common building blocks of a portfolio. First up, stocks. They represent ownership in a company and offer the potential for high returns. But it's important to remember that prices can fluctuate, rising or falling sharply in the short term. A company's stock price is generally driven by the expectation of its future earnings and profitability. When investing in stocks, it's helpful to have a long-term outlook, tolerance for ups and downs, and do research into the individual companies. Next up, bonds. They generally offer regular interest payments and are considered less risky than stocks. They're a type of fixed income investment. As interest rates rise, bond prices typically fall. So, while bonds may offer stability, it's important to understand these factors to make informed decisions. Then there's cash. It's considered the most stable asset of all, but it can lose its value over time due to inflation. It's helpful in a market downturn, though, because it can float you through an emergency. Now, let's talk about allocation. Asset allocation is simply deciding how much of your investment pie you want to dedicate to each slice. Stocks, bonds, etc. The nice thing about allocation is that you can assign target percentages in your portfolio to each type of asset based on your needs. Let's check out some examples. Maybe you want to build a portfolio that's more conservative. You could assign 50% of your portfolio to bonds, because bonds tend to be less risky than stocks. Then you could assign 30% to short-term investments, 14% to domestic stock, and 6% to foreign stock. But if you're okay with a little more risk and want a portfolio that's focused on growth, then you might invest more in stocks. Each slice of this pie represents a different type of asset and how investors get exposure to a variety of investments. You could assign 49% of your portfolio to domestic stock, 21% to foreign stock, 25% to bonds, and 5% to short-term investments. Friendly reminder, this is just an example. How you diversify is up to you. Let's zoom in on this domestic stock slice so we can see the ingredients. There's a whole collection of different funds and companies that represent the US stock market. You could have individual stocks you pick on your own, mutual funds, or ETFs. Let's zoom into this mutual fund over here. These ingredients, or companies, have been hand-picked by the fund manager who selects different stocks and/or bonds to try and achieve the goal or objective of that fund. Think of your investment portfolio like a wardrobe. To be ready for any occasion, you need a variety of clothes. A diversified portfolio needs a mix of different investments like stocks, bonds, and real estate to be ready for whatever the market or economy brings. If you want to simplify things for yourself, asset allocation funds could help. They're a type of mutual fund that are like having a stylist for your investments. These funds provide a ready-made, diversified portfolio in a single package run by a professional investment manager. They'll manage the fund according to its specific goals, like hitting a target date. Asset allocation funds help you achieve a more diversified portfolio targeted to a specific target year or risk level in one step. We're going to look at only one example: target date funds. They're an option for those who want a simple way to invest for a specific goal, and in this case, we'll be focusing on retirement. They have an asset mix of stocks, bonds, and other investments that automatically adjust the fund's investments over time, starting with more risky choices like stocks, and gradually shifting to more conservative ones like bonds as they get closer to the fund's goal, or in this case, retirement. It means you don't need to be an expert or spend a lot of time managing your investments. While target date funds offer a convenient way to invest, it's important to remember that they don't offer guaranteed returns, and you could lose money, including the principal invested. Well, that's it for this video. Got a question? Drop it below in the comments or check out Fidelity on social, where they discuss all sorts of topics like this and more. Till next time, investors.